Hello everyone, today I'm going to share with you some of the most interesting charts in the latest research report from Bank of America Global Research. The first chart here shows you the US private sector financial assets as a percentage of US GDP. And this one not only includes stocks and bonds, but also includes cash deposits, loans, private equities, and pension fund reserves. So it's significantly higher than the GDP right now. So it's currently about 6 times higher, and it's near its record high of 6.3 times higher. Happened in June of 2021. It's one thing to note is that it's currently way higher than the 2.9 times in the 1980, and it's obviously showing a clear uptrend in the chart. And it's also highlighted the QE era since the great financial crisis in the 2008, where the central bank learned how to print money. It's obviously caused a exuberance in the economy. And I think this chart shows you that where the wealth in America is concentrated, and I think it also shows us the importance for retail investors to participate in the financial market. This chart is the MSCI ACWI, or the All Country World Index regional share by market cap since 1998. So as we can see, it's dominated here by the dark blue, which is US, right? US accounts for 65% of the global equity market capitalization, which is at a record high. And one thing to note is that Europe currently accounts for 15% of global market cap for the equity, and EM stands for emerging market. Emerging market currently account for about 10%, and this includes China. Okay, and Japan currently account for about 5%. One thing to note is that Europe's and Japan's share of global equity market is down significantly from back in 2008 great financial crisis. Japan's here, Europe was here. They used to be 40% combined, and now if we look at them today, they're down to about 20%. Okay, so in the past 12 years, the market cap for them is down pretty much 50%. Okay, it's a market cap percentage in the world. Okay, so I think the key takeaway is that the investor needs to be mindful of the over concentration of the US stock market in the world. And this chart shows you the top 5 companies as a percent of the S&P 500 market cap. Okay, so the US equity market has never seen such, or have never seen more concentration of the top 5 stocks in history. Currently, the top 5 stocks are Microsoft, Apple, Nvidia, Alphabet, and Amazon. It hits an all-time high of 29% recently in July 2024. Okay, and if we look at the previous times, right, 2020, when COVID first hit, the top 5 stocks were just about 25% of the S&P 500, and back in the 2000 dot-com bubble, it was about 17-18% for the top 5 stocks. So I think the investors needs to be aware of the extreme concentration of the large cap technology stocks in US that's happening right now. This chart shows you the ACWI All Country World Index top 10 stocks as a percentage of the total world market cap in different years, right? This is July 31st, which is this year. Recently, we have 2021, 2009, 2007, and 2000. The so-called Magnificent 7 stocks, they are highlighted in red over here, okay? And they all made it to the top 10 world stocks in terms of market cap. And beside these 7 stocks, we have Aramco, which is Saudi Arabia energy company. We have Eli Lilly, which is a pharmaceutical company in the US. We have Broadcom, a semiconductor company in the US. Okay, one thing to note is Microsoft, right? They happen on all the lists. Okay, There's one here and there's one here. It's the only stock that's able to remain in the top 10 stock market cap in the world throughout 21st century. And right now, the top 10 stocks, they combined market cap, they represent 25% of the total ACWI market cap today. And it's a dramatically increased from the 2009, where they only represent 10% of the total market cap. Okay, I think from this data, it's important for investors to be aware of the sector rotations, because if you look closely, right back in before the great financial crisis, the number one used to be, right, we have ExxonMobil, the energy company. And back then we had a lot of other stuff, right? Like Walmart, we had Cisco, General Electric, even China Mobile. We had a lot of other stuff, right? We even had the Russian energy company, right? So it's people need to be mindful of the sector rotation. What's leading today might not be leading tomorrow. So we need to be cautious about assuming that the current technology giants are always going to dominate. Right? We got to be careful feeling overly attached to the current stock market leaders. And this chart shows you the U.S. equity versus U.S. government bonds or treasury bonds in terms of total returns. Okay, it's a comparison of the total returns for the past 120 years, because the start date is 1900. Okay, so as we can see, the U.S. stock return is at all-time high in comparison to the treasury bond total returns. And of course, there is a clear uptrend in the past 120 years. Okay, I think it's showing us that long-term wise, the long-term performance of U.S. equities is outperforming the treasury bonds. And as we can see, the outperformance or the uptrend is getting steeper around this area, right? Right after the great financial crisis, where the Federal Reserve discovered money printing mechanism, which they call QE or quantitative easing. This is a chart of the U.S. government debt, okay? And it's obvious that the moment where QE or money printing was discovered in 2008, right? The government debt goes up a lot faster than the historical speed, right? It's telling us that the moment they discovered money printing, they start to spend like crazy, okay? In 2008, the total U.S. government debt is about $9.5 trillion, and we are currently at $35 trillion, okay? So quantitative easing not only give Federal Reserve the tools to continue lower treasury bond yield, for example, the 10-year treasury yield, because their Fed funds rate is pretty much already at zero, okay? So the QE helped them continue lower the long-term interest rate, and it also, as a side effect, okay, it funds the government spending at a scale that has never been seen before, which caused the economic exuberance, which translated into the market exuberance, right, after the 2008 financial crisis. So I personally think, right, it's telling us that the importance of the equity market exposure for long-term investors. Okay, thank you very much. If you think it's helpful, please click on the like button, please share, please subscribe to my channel. Thank you.